G'day and welcome to the Motley Fool YouTube series, What I've Been Reading. I'm Scott Phillips, the Motley Fool's Chief Investment Officer here in Australia. I've said this to you before. If you've watched this series, then firstly, thank you and welcome back. If you haven't, our analysts are really smart people. They read a lot. They are curious. They like to know what's going on, and they normally get it through reading, whether it's a book, an article, a research report, whatever it is. We learn a lot of stuff from reading, and we thought we might as well bring that to you in this format. So that's what we do every week, every single week. So make sure you subscribe to the YouTube channel if you want more of this. Plus, Stock of the Month, Stocks in Focus, lots of great stuff, right? So please subscribe to the channel if you're enjoying it. But all I should do next is introduce Motley Fool analyst Darius Zagami. Darius, g'day.
Hi, Scott. How you going?
Mate, I'm very, very well, thank you. And I'm very excited about the book you've brought to us because I don't know if I've got a copy of it behind me. I think I do. If I spin around now and have a look, you'll see the back of my head. No, I say it's not very good TV etiquette, so I'm not going to. But it's a great book. It's called The Little Book That Builds Wealth by Pat Dorsey. The Little Book series are great. There's a whole heap of them that are really, really good. Little Book Behavioural Investing, I'll throw out, by the way. Not we're going to talk about that today, but also very, very good. Plenty of others besides. But mate, let's talk about The Little Book That Builds Wealth. I assume it's a little book. I'm actually, if I don't know what it is, I've seen it. But tell us, what is The Little Book That Builds Wealth about?
You are right. It is a little book. Unfortunately, I thought I had it with me, right, but I have misplaced it temporarily, so it's not on my desk like I thought it would be. But really, the book it really provides a timeless guide for how to, as the book suggests, build wealth. And it does that through investing in high quality companies, something we really like here at the Motley Fool, of course. But I really want to start, I guess the best way to describe the book is at the start, it has Pat Dorsey highlights what he calls the game plan, sort of sets the scene for the book. And this is 4 steps for building wealth. And the book really focuses on the first step mostly, but the 4 steps I thought were fantastic. And it lines up quite well with our investment philosophy at the Motley Fool. So step 1 is identifying businesses that can generate above average profits for many years. Step 2 is to wait until those shares in those businesses are trading for less than their intrinsic value and then buy them. And then third is hold those shares until either the business deteriorates, the shares become overvalued, or maybe you find a better investment that you like more. And importantly, and again, our views at the Motley Fool, holding period shouldn't be measured in weeks or months. That holding period is years. And then the 4th step sounds very, very simple, is just to repeat as necessary. But the book, as I said before, is mostly about that first step, identifying a business that can generate above average profits over a period of time. And the way this is achieved, basically, as Dorsey puts, is through identifying what's called a moat or a competitive advantage. And these are really important because they can protect companies from competition, they can help them earn more, and they can make a company much more invaluable to an investor.
Nice. I like that. Of course, Warren Buffett, famously, speaking of great investors, popularized the concept of the moat, a moat around a castle filled with choose your preferred animal or sludge of choice. Sharks with lasers if you're an Austin Powers fan, but find something that fills that moat to keep the enemies away and help your business, your castle, prosper. I've kind of given you, I've kind of stolen a bit of your thunder there. That's what a moat is, at least in medieval terms. But how does a moat apply to, you've kind of already mentioned it, to businesses when it comes to investing?
Yeah, so to quickly describe what a moat is in economic terms, it's really something that makes you better than your competitors in some way that they can't easily replicate. So there's 2 different kinds of moats, basically. There's a moat that enables you to increase your price more than your competitors. You'll have your customers come to you over your competitors. And then there's one that can help you to decrease your costs more than your competitors, which, of course, you can maybe decrease your prices then if you would like to, or keep your prices the same. And so moats are things like intangible assets. So intangible assets can come in many different forms, I guess. So you've got brands like Adidas, for example, or Coca-Cola. They have very powerful brands. You've also got things that can keep your competitors from being able to replicate your products, like patents. For example, a lot of medical companies will have patents, and they'll be the only one able to produce that product up until the patent expires, of course. High switching costs. So this is really just if your product, if using your product is doesn't change easily to the competitor's product, if it costs them a lot of money or effort or time, they won't want to change, and that in itself can be a competitive advantage that, or a moat rather, that allows you to increase your price, knowing your customer just can't. And then the final one that I wanted to highlight on the price side of things is the network effect. So this is a really moat where basically as more people use your product, more people want to use your product, and people want to use your competitor's product less. A perfect example of this would be something like a dating app, for example. If everyone is on your dating app, no one wants to be on the other people's dating app. If there's only 10 people on the other person's dating app and a million on yours, you can tell which one the next person who's looking for a dating app is going to buy. Credit cards also work along the same way, auctions, even the stock market can work in this way. So if you've got everyone wanting to buy shares on your stock exchange, no one's going to want to go to the other, no company is going to want to list on another stock exchange. But on the cost side of things, yes, very true, very true. On the cost side of things, just a couple that I really quickly want to touch on. This is just things that you, like I said, have your prices cheaper. So a big cost advantage can come from having scale over your competitors. So, and I don't mean scale overall versus your, like overall in the market. You can be a really big fish in a big market, but it's actually much better to be a big, small market than being a big fish in a bigger market, because it means you can have much better scale advantages over your competitors. But that's just a few moats I wanted to raise for members.
Nice, mate.
And,
really
and viewers.
Yeah, really good list, mate. Thank you. Normally at this point of the conversation, so what should investors take away? The challenge for this book is the entire thing. I mean, that's exactly the way it's geared, right? I love the way Dorsey sets up the 4 steps and then really digs into the first one, which is really where the difficulty is, right? Because the other stuff is, I mean, it's not super easy, but it's not super hard, and there's not a lot to expand on, right? Just hold your shares, don't sell them, hold for years. Kind of, that's kind of easy-ish, at least in the telling. Much more meat, much more detail in the moat piece. Is there anything particular that surprised you, or you want to leave our viewers with? Anything you want to kind of just mic drop at the end of the conversation? Say, hey, for all of that, here's what I really want our viewers to know.
I think you raised it really well. It's not as easy as it sounds. Dorsey makes the book sound really, really simple. He summarizes it really well, but there's still a lot of work to be done. And one thing I want to raise really is it's not just about identifying a moat. It's not just about buying a company at a reasonable price. There's a lot more that needs to happen after you've bought that company. Moats aren't forever. They can be eroded over time, and they are eroded over time. Patents expire. Brands lose their share. Another company invests significantly into building its brand, and consumer tastes maybe change, for example. So what I would like to say to viewers is it's important that you're buying these companies, but you're also monitoring the company over time. If you're lucky, the moat that you've identified might be growing, and that might actually present an opportunity to buy more of a target company. But if you're looking at this company over a period of months and years, you should see a trend that shows you whether that moat is growing or whether that moat is deteriorating. And that's what I'd like to leave you with.
Beautiful, mate. It's a lovely thing to finish with as well. I like the idea of monitoring it because you're right. Dorsey sets up how to start, not necessarily how to keep going. So a lovely addition to that book. Phils, if you enjoyed the chat, I'm sure you have, go and get yourself a copy of the book. As the Little Book series are great. Behavioral investing builds wealth. It's a little book that beats the market. I think might be another one. There's some really great ones. I think they've kind of expanded. A bit of editorial. We've expanded a little bit further than I would have expanded personally, but that's okay. Those 3 are well worth looking at. I guess we've got a good franchise. Just stick with it, right? We hope you've enjoyed this particular video. Darius, thank you for the read. Thank you for sharing your thoughts about it with our viewers. If you have enjoyed it, please do the usual YouTube things. Please like the video. Please subscribe and hit the notification bell. Another one of these in a week's time. In the meantime, we'll have a Stocks in Focus once a month. Stock of the month, where we pull back the curtain on an actual Motley Fool recommendation. Free on YouTube. That's a pretty good deal. Motley Fool TV, we do YouTube Q&As, all sorts of fun stuff. Occasionally I do a bit of a rant too, just quietly. So yes, that's all. I either do or don't come for that. I'm not sure if that's a good thing, but in any case, you will find those there. Thanks for being part of our YouTube community. Thanks for being part of the journey. Until we speak again, Fool on.